I believe we do it in this way. So first we will discuss the main material of today's class. And then at the end of the class today, I will comment on the upcoming attractions that we have, mostly on the midterm exam, and also you can ask the questions on the first homework that we uploaded and that you should work on. Let's go. We covered the main. We covered the part when we discussed about the two main types of securities that are there in finance. We discussed the stocks and bonds, and now we move to the main estimations of the performance of investments in those assets and what we are looking at. Then we talk about the performance, or how good investments are, or we can formulate it in different way, like what distinguish between good and bad investments, wherever. Those are two groups of estimations that we work on. Those are estimations of risks and estimations of return. The estimations of return are easier to figure out. There is less ambiguity what we can call return, and it is quite clear what we mean by that. And we will start with that. So first we will talk about the return estimation. There are some particularities to pay attention to in order to avoid the mistakes, but in general this is quite the straightforward task to estimate the return. Return of the assets in the past. Predicting the return is also quite a tricky thing. But in order to predict it, first we should know how to estimate it historically, and that is what we start from. And second group of estimations regarding the investment performance are related to the risk. And risk is a more difficult concept, and it is we cannot say that everything is completely settled there. There is still a way for improving it. There are in different periods different things were called by risks. I will introduce you to the main understanding of this phenomenon, and also we'll start from the estimations that are used in order to estimate risk. We will talk about the risk of the individual assets, so of the assets by itself, and also we'll talk about the estimations of the risk within the portfolio. Within the portfolio, we mean that of the risk of one asset when there are multiple assets groups together. So this is the in broad picture of what we are about to discuss today. And we spent multiple classes on talking about estimation of risks and return. The next class will be also devoted to it, but I must say that the material that we cover on the next class will not be included into the midterm exam due to the limit of time. But so this is the last section that will be included in the first midterm exam. The rest of the materials will be covered in the final exam that we'll have with you at the end of the next module. This is a brief introduction. Let's proceed to the content of today's class. This is the topics that we will focus on today. We'll start with discussing of return on a single asset, on the security in this case, but no, it can be applied to multiple different dimensions. So to any assets, the way we estimate return would be pretty similar. Return of the portfolio, because when we invest and when we do financial investment, we usually try to invest in multiple assets simultaneously, not just picking the single assets and invest everything there. It is usually not the best option. I will demonstrate to you why it is not the best option today. There is a rigorous mathematical explanation why we should invest in multiple assets, and multiple assets combined together, they are called the portfolio. Portfolio, this term is used in multiple dimensions, including finance. Like as a university, we have the portfolio of educational programs, and as an investor, you can have the portfolio of assets. And estimating the return of the portfolio is also quite simple thing to do. Just there are few points where you might make a mistake, but the logic is quite straightforward there how to do this. Then we will proceed to the more difficult thing, but still the logic there is quite straightforward. And we will discuss how to estimate the risk of individual security, and then how to estimate the risk of the portfolio. And the point there would be to compare those two. And the risk of the portfolio, so I just told you that when we do investment, we prefer investing in multiple assets. So investing in the portfolio rather than into the single asset. And the main reason for that investing in the portfolio reduces our risk. There is this famous quote: "Do not put all your eggs in the single basket," and this is very relevant for the financial markets. And we will discuss that. In the later 2 points are about the effect that we achieve due to the adding multiple assets into the portfolio, and then we will, at the end, we will talk about the way how to estimate the risk of asset within the portfolio. Let's move further. There is this is the historical chart. When we talk about the time periods of 100 years, there is not very important to update them each year, so this picture is still relevant. This picture presents the comparison of the return of the multiple types of assets. And you can see that there are, this is the escalating scale. This is, you see that on the top, the return of the group of assets which are the most lucrative, which have the highest return, is 32,645. So this is amount of money we would have if we invest $1 at the beginning of 1926. This is how much money we would have from this amount in 2018. So if we choose the small stocks of the publicly traded firms, then the amount that we would have would increase by 32,000 times, more than that. If we would be more conservative and prefer investment into the more stable groups of firms, of the large firms, also publicly traded, then our return would be 7,000. No, not return. Our return would be 700,000%. In other words, amount of money that we would have would be 7,030. those are the most those are the assets that provide the highest return. Alternatively, if we are conservative people, we can invest into the bonds. There are two types of bonds presented here: short-term state bonds, which are called treasury bills, and long-term or middle-term bonds, the different bonds, except the short-term bonds. They are called government bonds. And those bonds would also provide us some return, but return effectively will be way lower than the one we have for the stocks. But at the same time, so it would look like the investment, the risk, that the return, that the investment into the small stocks is a way better option by any dimension. But actually, it is not the case. Let's consider, for example, not everyone has 100 years investment horizon. Yeah, let's say we would invest somewhere in 1930, and we would need to take our money back somewhere here in this period. And we see that the government bonds during that period, they grew quite stably. They provide as you remember that the state bonds, this is the least risky asset, and the return there is known in advance. And the only thing that can happen is a default. Then the bondholder is not able to service the debt. But when we talk about the states, it is a rare case. So mostly we are quite certain on the cash flow that we receive. But on the other hand, if we invest in the firms, in the stocks of the firms, we participate, as it is usually put in the course books. We participate both in upsides and downsides of the business. So when business doing fine, we have a superior return. If business doing bad, we have losses. Yeah, and in this case, there are multiple periods during this 100-year investment horizon. Then investment in the bonds would be better than investment in the stocks. But if we take her investment horizon that is long enough, then those risky assets are always better. They would always outperform in the long run, but in the short run, there are multiple periods, then it is not the best option to invest. And this tendency, so how likely the stock price or price of the asset to fall, how volatile it is, so how much it moves up or down during the period, or is it straight like this one? This estimation is what we mean by risk. And as we started from this premise in the early beginning of the course, and this is relevant here again, the more risky asset, the higher return we should demand. And now we can see it numerically. We can prove this numerically using multiple assets. Let's start from the discussing the way we estimate the return. The basic return of the basic estimation of return is just the total. It is an estimation of the relative income that we receive from investment in any asset. It is relevant for any type of assets. In this case, we mean stocks, but instead of dividend, there can be coupon, then it would be holding period return for the bond, or any other cash flow that we receive with this type of asset. So there is the capital gain. This part equals this part. There is a simple mathematical transformation that we make in order to go from this one to this one, but no, we can do it like this. Also, usually this type of writing is simpler because there are less components here that are included, but of course they are always equal. And there is also dividend yield. So there are two types of two streams of returns. The first one is the return based on the capital gains. So due to the change in price of the assets between the moment we purchased it and the moment we sell it, or the moment we make our estimation, if we do not sell it yet. And other stream of cash flow comes from the dividend yield. As we keep assets, there are many types of assets that provide additional cash flows for us. It might be dividends, it might be coupon, it might be some other cash flows that we receive for having these assets, and all of them will be combined in this separate component. In this case, we call it dividend yield. Simple, brief example on this formula. What is the holding period return for an investor who bought a stock a year ago at $50 and received $5 in dividends over the year if the stock is now trading at $60? This is it. We apply the formula: final price, initial price again, and the dividend that we received during this period. So at the top of the denominator of the equation, we have return, we have income that we generated. At the denominator, we have investment that we made. Investor is a price that we have to pay for a stock. And holding period return in this case is 30%. If we talk about annual return, this is a very good result. When you will deal practically with return estimation, we should consider multiple corporate events, and we also, it is more convenient to do than we just comprise the formula having all information out of the prices themselves. And when you look at the stock market data, the Yahoo Finance that we recommend using for downloading the data for your homework, you will see that there are closing price and adjusted closing price. And the difference between those two, that adjusted closing price is modified in a way that using only this will provide us with a return that include all other cash flows that investors would receive for investing in this stock. So it is adjusted for dividend, adjusted for stock splits if they took place, and we can work with this simple formula, putting together all the cash flows that this asset would generate. Another thing to understand, to keep in mind, is how we can convert from the shorter period return to the longer period return. If we have, let's say, quarterly returns, we can use the principle of compounding, which is by this moment should be already well known to you, to estimate the return for a year. So this, if each R on this picture represents the return for a quarter, then we would have return for 4 quarters, and putting them all together, we will have annual return. Yeah, so make sure that you do not miss any return, otherwise you will have a wrong estimation. But if you have, you might have months, days, wherever. And by the way, the some hint for the homework that you make sure that you work with the when we convert annual return to the daily returns and vice versa, we talk about not 365 days, but we talk about something like 250. It's different year by year. We talk about only working days, because during the weekend, stock exchange doesn't work, so price doesn't change, so there are no returns for these days. So daily return is the return only on the working days. And when we convert annual to daily and vice versa, please make sure that you consider that. Here is an example for this formula. There is 4 returns for different quarters. And by the way, here we see why we need this 1 here. If we would have negative return, we won't receive the correct answer then. Yeah, so if and return on the most of the assets cannot go below -100, because no, we asset price mostly, when we talk about stocks and bonds, it is always like that. Their price cannot fall below 0. In other words, the return cannot fall below -100. And that is why that formula would always work. We apply this formula, having this result, and usually then we work with the return estimation. We usually have some benchmark or objective or something that we compare our results against. And in this case, we have a benchmark of 12%, and our return is 13.1. It means that we are successful here, so our results outperform the benchmark. Another term, so far we talked about holding period. Return, this is the return for the period that we hold. It can be any period. It can be multiple seconds if we talk about high frequency trading, or it can be multiple dozens of years if we talk about the investment for the retirement. Any of this period, we can have holding period return for 20 years, holding period return for 10 seconds. It doesn't matter, just no, all of those we call holding period return, just we should clarify which period we mean. In order to make return comparable, we should convert them to the same time interval. And most of the time, the default time interval is annual. So a time interval of 1 year. And there is a formula for converting returns for the annual terms. It is called the compound annual growth rate. It is based on the principle of the compounding, so on the compound interest. And in order to estimate compound annual growth rate, we need the final price, we need the first price, and the number of periods, number of years. And there are usually multiple periods, and then we would have here a number of years. Also, we can do it vice versa. It is not common, but it's technically possible. If the time interval here is less than 1, then n can be also n can be also less than 1, and then we will increase this amount by this multiplication. So the purpose here is to convert the these results to the annual terms. Let's look at the example again. Here we have a historical prices of the Yandex stock in United States dollars. Those are the prices each year. We estimate the return each year. We can this divided on that minus 1 will have the growth or return. We might also write here, in this case it would be the synonyms. You see, some periods were successful, others were not that successful. So there are some instances that the stock price fell by 60% within the year. So in this period there was a huge fall in the price. But finally we take the first return, we take the last price, we take the first price, and we estimate the compound annual growth rates. Please note that these 8 numbers here is the number of steps made, number of difference, number of returns. There is 9 prices here and 8 returns. And here we make here this 8 is a number of steps, of years within this period. How many years passed in the January 2020 from January 2012. It's 8 years past. Please compare this result with the arithmetic average. Arithmetic average is also a relevant concept, but arithmetic average is something that we can use in order to predict the return. So if we have some historical data on the returns, and every year return is different, and we want to say what return to expect in the next year, we can do just arithmetic average here. And this would be the result. But actual return that we had during this period, so instead of all those different returns, we might have annual return every year of 10.38, and we would start from 20.34 and reach 44.81 by this period. Yeah, instead of all those different, we might change them with this return every single period. And this is compound annual growth rate. So compound annual growth rate assumes that we do reinvestment every period. So everything we earned, we reinvest back in the price and come up with some result. Final estimation of return that we should discuss today is the return for the portfolio. We put multiple assets in the portfolio, and the way to estimate the return of the portfolio is just to estimate the weighted average. Here you should be careful doing that. Applying this formula, it is important that the fraction of the assets in the portfolio, we should take it at the beginning of the period, and the rate of return should be not just for some single period, for a year or month or wherever we work with, and we do it. We can apply this formula once only. Then, when we reach the next point in time, then the fraction of assets in the portfolio would change by the next period, because each asset has different return, and as a result, the fraction of this asset in the portfolio would change. So if we have, let's say, 2 assets into the portfolio, initially the price of the first assets of both of them is 5 and 5, so each of them constitutes 50% of the portfolio. So fraction of the assets here would be 50. No, 0.5, and here we would also have 0.5. But at the end of the period, let's say that the first asset grew and became 8, but the second asset price fell down and its price became 2. Yeah, then we start subsequent period with the fraction of the first assets equal 8, 0.8 or 80%, and the fraction of the second asset would be 20%. So the fraction would change every period, and please be worried when you apply this formula. In practice, when you do your homework, the optimal way to estimate the return is to recalculate the price of the portfolio each period. So multiply the price of each asset to the number of these assets into the portfolio, and make this calculation for the entire portfolio, and have the portfolio price for each working day. And then you can work with this price and make this basic estimation, for like here, to estimate the return there. Then you would avoid any mistakes. But still, this formula is relevant when we make a one-step estimation of the return. You can apply it and you will have the correct answers. In order to make the step to the subsequent part that we cover today on the risk, please note one thing. Then we worked here, in order to estimate the return for all 8 years, we used just the last price and the first price. We ignore all the fluctuations that happened into the between. So as if there is just a straight line here. But as you see, there are a lot of fluctuations. And if, for example, instead of investment horizon from 2012 to 2020, investment horizon, if it would be from 2012 to 2015, then instead of then our return would be negative. Instead of growth, there would be the reduction of the price. So from here to somewhere here. Yeah, so this estimation is very sensitive to the particular moments in time that we consider. When, as I told you, then the investment horizon is long enough, mostly on average, we have a positive result, but there are quite frequently results are not positive. And if we talk about the shorter term period, it's more and more relevant that we might face a situation then the results won't be positive. And this is very important characteristic of the assets, that the chances that our return would be negative. And this is estimated by the group of estimators, risk estimators. So this situation that results might not be positive they also might be negative. This the concept that deals with this problem is the concept of risk. And this is the concept that we are about to discuss with you. Risk is a hazard, a chance of bad consequences, loss or exposure to mischance. This is a definition from the Oxford Dictionary. There are multiple bullet points that I mentioned here that are relevant to this concept. We can call by risk the events. Risk can be caused by events, decisions, the terms that are related with the risk are uncertainty. And risk is an estimated uncertainty. Sometimes we can see this definition of the risk. Traditionally, and in many cases, for example, here in this Oxford definition, we see that people focus only on the downside of the risk, that the chances that we will have losses or we would have some negative outcomes. But in finance, as this idea that we are coming back almost every course, the idea of idiosyncratic or undividability of return and risk. And those concepts, they shouldn't be considered separately in finance. The more risky assets, the higher return it would get. But the more risky means that there are chances that return can be actually negative. And that is why then we talk about the risk. We also talk about the upside part of this estimation, of this thing. So the risk is the chances of things to deviate from our expectations. They can deviate positively or they can deviate negatively as well. And those all, so we invest into the risky asset hoping that things will deviate more positively, but they might deviate also more negatively. And in this case, in this sense, those terms are very much related one to each other. There are, depending on the way how much we informed on the situation, risk is a concept that reflects the estimated situation of the uncertainty. Uncertainty is the situation then there is some we don't know what happened, but there are some estimation, some understanding that we have of the potential outcome, and then there is no understanding at all. We call it randomness. So those three terms, they are ranked on the level of understanding. So randomness, then we cannot say almost nothing about what's about to happen, and the risk, then we already have some estimations of it. Here are some groups of institutions or person who this concept is relevant for. And this, for us, we focus mostly on the financial part of the risk, and this is of course very relevant term for this subject and for the financial performance of the firm and for anyone related with that. Let's talk how we would estimate the risk. The basic mathematical tool to estimate the risk, they are mentioned here. They two are very much related with each other, as the standard deviation is the square root of variance, and variance is the average value of deviation of the variable from its own average or from its own mean. It is a measure of volatility. It is a measure of how frequent or how likely the asset to the price to change. If we look at the chart, the more changes we have on this assets, so the less straight the line, then the more volatile it is. And the standard deviation is the square root of it. We work with a squared invariance in order to put together all the changes, both positive and negative, because if we will not have the square there, then positive changes would compensate for negative changes, and then it would be equal to 0. But we need some estimation of any type of changes, and that is why we work with the squared estimations. We will talk how we do it, and in order to have estimation of return, we mostly work with that estimation of the risk of return in the same scale as our return, because invariant we went to the squares. In order to have in the same scale, we work with the standard deviation. Let's consider estimation of the standard deviation. Here we have an example of the coin toss game, how we would estimate the variance and standard deviation, but we can do it for any type of uncertain event. We have return for if we toss the coin 2 times. If we guess all the time, if we guess 2 times, the return would be 40. If we guess 1 time out of 2, the return would be 10. If we miss 2 times, the return will be minus 20. The process, how we estimate the standard deviation. If we have the probability of outcome, then we do it like that. We would estimate the mean here. So there is 40 plus 10 plus 20, minus 20. It is 30. We divide it on the number of outcomes. There are 3 outcomes here. So the mean here would be 10. Then we estimate the deviation from expected return. 40 minus 10 is 30. 10 minus 10 is 0. Minus 20 minus 10 is minus 30. Next step is to go for the squared estimations in order to, as I told you, to consider both positive and negative deviations. The next step is to multiply them on the probability of these outcomes. This is how we got 225, by multiplying 900 on 0.25. Finally, we find the sum of those numbers. 225 plus 0 plus 225. This will be 450, and the next step, and this 450 is the variance. Next step is to estimate the standard deviation, and here it is a square root of this number. So, this is already rounded here, and this is the 21. So the 21, it is in the same scale as 40 here. It is in percentage point, and here it is. If we have instead of probabilities, we might have just the many returns. then what we would do, we just do the same procedure. We estimate their average, estimate the deviation of each return from the average, find the square of this deviation, and then we would ignore this part, would just find the sum of this column, and then divide it on the number of observations to get the variance. Then take a square root of it to have the standard deviation. This is the chart for the volatility, for the variance of the Standard & Poor's 500. So this is the index of the biggest firms in the US. And you see that during the crisis period, the volatility always goes up. So the prices deviate stronger than usually. Then we think how to reduce the risk, how to reduce the volatility, what we can make in order to make safer returns, to be more certain that we receive what we expect. The simple and effective tool here is diversification. This is a strategy of reducing the risk by spreading the portfolio across multiple investments. So in more simple term, to invest in different assets together, and this is the way to reduce the risk, and we will demonstrate how it works. So it's we usually not just randomly pick any assets, but there are strategies of diversification. So we choose assets purposefully with the idea in mind to reduce their volatility of the portfolio. And this would reduce the risk of the portfolio. The risk of the portfolio usually and mostly smaller than the risk of the individual asset. And in terms of and depending on whether it is possible to get rid of the risk or reduce the risk with diversification, we distinguish two types of risk. There is unique risk and market risk. There are also market risks sometimes called systemic risk. Unique risk might be called specific risks. So there are some synonyms for that, but they all are about the same phenomena. If we can get rid of the risk, so here we have a unique risk, or here they call specific. If we can get rid of the risk by having more assets into the portfolio, so this fraction of the total risk, it is called the specific risk or unique risk. So risk factors that affect only the firm, that are specific for this risk, or they are unique for this firm. Then we can diversify them away. So if risk relevant only for one firm, by having many assets together, we get rid of all things that are relevant only for one firm. If the risks are relevant for all assets within the portfolio, then we would call them market risk. And those types of risk, we cannot diversify them away. They remain. Depending on the level of diversification we have, we might reduce this part. For example, we can start from diversification within one country, then we have this market risk for the market of this country. But then we can introduce the assets of another country. Yeah, and then we would have lower market risk because those some part of the risks which are specific for particular country will be also diversified away. But still, market risk remains anyway because there are no portfolio which has zero risk. And if we look at the other perspective on the effect of diversification, here we have two stocks. Newman, this is the gold mining firm, and Ford, which is a car manufacturer, and the blue line is the performance of the portfolio. And you see that performance of the portfolio has way smaller volatility. It is way less volatile. By the chart, we can see that. So this is quite stable. It remains stable when something went up, others goes down, or vice versa. It can be if we would take another time interval, but the portfolio would remain stable, and as the economies in general have tendency to grow, the portfolio would grow as well. How we estimate the variance? We remember that knowing the variance, we easily can estimate the standard deviation. How we estimate the variance of the portfolio of the two stocks? There is a table structure that we work with in order to do this. There are multiple factors that are involved. Sigmas here, this sigma and this sigma, and sigmas here and here, they represent the standard deviation of a relevant stock. If we have number 1 here, we mean that standard deviation of the stock 1, as it's squared, this would be variance of the stock 1. X here, X1, is a fraction of this stock in the portfolio. This rho here, it is a correlation coefficient. And rho, correlation coefficient of return between stock 2 and stock 1. Rho multiplied on the standard deviation of those two gives us covariance. This term here is a covariance. You see that these are equations because this thing is equal to that one. And in order to estimate the risk of the portfolio, we find the sum of this value of all the values within this table. Here it is. Return of the portfolio we already discussed with you. This is a fraction of assets and return of each asset. Return of the portfolio for two stocks, we do it with this formula. The fraction of the first asset into the portfolio squared the variance of the first asset into the portfolio of standard deviation squared. The same for the second assets, then 2, because we have two components here. That's why we have 2. Multiplied on this part, the fractions of each assets, multiplied on their covariance, or in other words, correlation coefficient on the standard deviations. This is the formula that we use in order to estimate the variance of the portfolio. And there are multiple conclusions that we derive out of it. Namely, this is how we would estimate the effect of diversification. We will use this formula in order to do this. Let's say you invest 60% of your portfolio in Johnson & Johnson's and 40% in Ford. The return on J&G is 8% and on Ford is 18.8. The expected return on the portfolio is something that we should estimate. Here it is, fraction of assets on their return. Then let's estimate the risk, standard deviation, and volatility of this portfolio. We move further and we have additional information that standard deviation of their annualized daily returns are 13.2 and 31% respectively. If the correlation coefficient is 1, what would be portfolio variance? This is how we would do. So we fill in the table with appropriate numbers, and this would be the result. And note that if we have 1 here, then this formula, where is it? This formula. If the raw correlation coefficient, if there is a perfect correlation between those two stocks, then this formula is we can convert it to what? Maybe someone can add. How we call it is a formula for Artyom, you better speak because I do not always see you. Let's tell me if rho here would be equal to 1. How we can simplify this formula? This is something you usually learn, I think, in 8th grade or maybe 7th grade in the school, in the middle school.
I think we can completely omit rho.
Completely omit. Yeah, if it is 1, of course we can completely omit it, but I mean the general formula. Yeah, this is, Елизавета wrote it in Russian, so there is a simplification. I believe those of you who studied abroad also should have it somewhere in the school. This is the square of the sum formula. So this, let me maybe draw it to you so you will recall it. This x plus y squared is equal to x squared. Usually we have this part with 2 in the middle, but in order to make it easier to see how it should work, I would put it like that. Y equals 2 plus 2x y. And this is what we can do with this formula. And no, here those x, y, no, this x is not is not the same as this x is just for the sake of the remembering the formula. In this case, x equals to x1 multiplied to sigma 1, y equals to x2 multiplied at the sigma 2. If rho equals to 1. Then we can just re-estimate it, and if you know, when you will receive the slide, you can check it. You will see that the standard deviation would be weighted average of the standard deviations.
Excuse me, can you show the slide with expected value for this for 1 second, please?
this one?
Yeah, thank you.
Yeah, so with this, yes, Elizabeth.
Thank you. Yes.
You just wanted to look. I thought there are some questions that you have. With the same formula, we can estimate the standard deviation only for the case of the perfect correlation. In other words, in the case of the perfect correlation, we have no effect of diversification. It means that the risk won't be reduced. Just the risk would be weighted average of the risk of the assets within the portfolio. But fortunately, there are not many assets out there that are perfectly correlated. Most of the assets are not perfectly correlated, and many of them have very little correlation, and sometimes they even have negative correlation. And this is where the effect of diversification is coming from. Let's compare our results for the case. Then the correlation coefficient instead of 1 would be 0.019. The formula would be the same except for this component here. And standard deviation instead of 20.3 would be 15.9. Yeah, so this is already the reduction of the risk. So instead of having the risk, which is a weighted average of those two, we have risk which is very close to the risk of the this Johnson and Johnson, which is 13.2, and here we have 15.9. But the return is higher. Yeah, so we returned what we had returned, 12.3 instead of 8%. Yeah, so we reduce the risk by also keeping the return. So the losses, the relative loss we have on the return compared with the, let's say, Ford, is smaller than relative than the gain we have in terms of the reduction of the risk. So we reduce the risk stronger than the loss in terms of the return. And this is the effect of diversification. And then assets are combined wisely, then we might have very good results out of that. In order to have to consider other extreme case, if the correlation coefficient are equal to -1, so if there is a perfect negative correlation, one asset goes up and other asset goes down with the same altitude, then this formula would change from the square of the sum to the square of the I would call that of the minus, and in this case standard deviation would be 4.5%. If we change the fractions of the assets, we can find the fractions of the assets that having the correlation coefficient of -1 would make us standard deviation of 0. But -1 is also quite a rare case, but I use it in order to illustrate how it works. And it works in the following way: the lower the correlation, the stronger would be the effect of diversification. So the strategy of diversification is based on the putting together uncorrelated or better negative, negatively correlated assets in a single portfolio. Let's illustrate it with a subsequent set of the examples. We have two stocks. This is their standard deviation, fraction of the portfolio, return. We put them together, estimate standard deviation, estimated the return. Correlation coefficient is put here. And here, this is where we used it in the formula. If, like I told you, that if we use weighted average, no, we can use it only for the case of the perfect correlation. But no, here we use it for the comparison against the result that we would have with a weighted correlation. Then, in other words, the case, then there is no effect of the correlation. What risk would be just what is the weighted average risk of all assets into the portfolio, and this is 33.6. But due to the fact that assets are not correlated, that correlation coefficient is just 0.4, the standard deviation of the portfolio is 28.1. And the return of the portfolio is 17.4. No, this is something we always estimate with a weighted average. Now we go to the next step, and we already have this portfolio. So this is the results we just estimated. This 28.1 and 17.4. They are here, and this is the portfolio. Then we introduce one more stock we added into the portfolio, having the 50% of previous portfolio and 50% of the new stock. Those formulas here are not written down completely, but here we have only the final results. And what we have here, compared with the previous portfolio, we have higher return, 18.2 against 17.4, and lower standard deviation, 23.43 against 28.1. So this new portfolio that we just achieved here beats initial one by both dimensions. So it is generally better by any sense. Less risky, higher return. And how it can be possible that things are so good? This is the effect of diversification. This is how it works. If assets are not correlated, so what we added into our portfolios, the stock with a higher return than average of we have in the portfolio, and also the asset here, even though it is itself quite risky, what is important for us is that this asset is not correlated with our stock, or with the rest of the portfolio. So this is 0.3, and this is how we achieve the superior result of the portfolio. Going further, in your homework, you would need to work with more than 2 stocks within the portfolio, but the principle is the same. As some slides ago, I introduced to the table for the 2 stocks, but you can do it for 3, 5, or wherever the number of stocks is. You just add on the lines in this table and find the sum of the values here, and estimate the standard deviation for the portfolio with any number of stocks. And also alternatively, again, what you can do, you can estimate the price, as I told you with the return, you can estimate the price of the portfolio at any moment, and then using those prices, you can estimate the standard deviation. Final thing that I want to introduce to you today is the estimation of the risk within the portfolio. As I told, there is a diversification is important thing, and there is a special tool that we use in order to estimate the risk of the asset within the portfolio. There is this market portfolio of all assets that are there in the economy. Usually we have S&P 500 as the market portfolio, and beta is a sensitivity of a stock return on the market portfolio. How we work with the beta at the previous class we talked about the Yahoo Finance and data on the stock. There was this beta coefficient, and this is what it means. It means that the return on Ford stock changes on average by 1.44% for each additional change in the market return. So beta is 1.44. And what beta basically is, it is just the coefficient in the linear regression. Linear regression is something you should know from the math or statistics, and we build the linear regression of the return of the stock having return on the market return as an independent variable, and this beta coefficient would be the same beta coefficient that one we have in the linear regression before the return on the market in the formula. If beta is equals to 1, then the return is the same as the average on the market. If beta is higher than 1, then return is then the stock is more risky than the market average. Then the beta is less than 1, then stock is less risky than the market. So it is less volatile. Including it into the portfolio makes the portfolio less risky. This is the formula that we use in order to estimate the beta coefficient, and this is a covariance divided on the variance with the market. On this slide you have an example of the calculation of the beta coefficient. So this is a market return, there is a return on the stock average for those two. They are the same just as a coincidence, they do not have to be the same. Then we estimate the deviation for the market return from its own average. So it's -8 minus 2 equals 10, 4 minus 2 equals 2, and so on. Here we have -11 minus 2 equals -13, 8 minus 2 equals 6, so on. Here we have that. Then column 6 is a squared value of the column 4, squared market return, and column 7 is the column 5 multiplied on column 4. Those are results here. Then we have in order to find the variance and the covariance, something we need to estimate the beta coefficient. The variance of the market return would be sum of the values here divided on the total number of observations. Here it is, number of observations 6. Number of values here divided on the total number of observations. Here is 76. Then we divide one on another, and we have here we have 1.5. When you final remark here, when you will do it in Excel, there are different formulas for the variance and the covariance. There is the one for the sample and the one for the population. And for the sample, instead of the number, we would divide by n-1 number of observation. But in finance, we do not need to do this. We should divide by the number of observation, of the actual number of observations here. And when you have a choice in Excel, always work with the formulas for population. Not for sample, but for population to have the correct answers. This is it. Do you have questions on today's class?
Yes, in fact, may I ask two questions?
Yes.
The first was published by me in chat, but I guess I can repeat it. Doesn't negative correlation negatively influence expected return? I mean, when there is -1, because the expected return formula, if I understood it correctly, doesn't show this negative influence, but it looks like if we have negative correlation, portfolio variance is reduced, but won't the return be reduced because of negative correlation? Because it seems to me that if they're negatively correlated, then we will lose in either case. For example, if one investment is profitable, then the second will be not profitable.
Yeah, it is true, but when we talk about the risk, we try to avoid the major losses there. So focusing on minimizing the risk and focusing on maximizing the return, those are two different objectives. Yeah, and then I talk to you that the best portfolio would be, in terms of the risk reduction, it's the one with a perfect negative correlation. I told you only on the dimension of the risk reduction. And the art of choosing the portfolio is to find the one that have a return which is high enough, but at the same time the risk which won't be too low or too high as well. Yeah, so there are.
Excuse me, shouldn't the expected portfolio return show this negative correlation somehow? Reflect, I mean.
No, it's not related to the. In order to estimate return, we do not need to consider correlation directly. It would affect the outcome, but it would affect due to by the changes in return themselves. Yes, so if they are negatively correlated, then most of the time this one would be positive, this one would be negative, and we will see this directly with that. Because here all the estimation, this standard deviation, they are always positive due to the nature of this estimation. And this is why we need rho here as a measure of the correlation.
Thank you, I got it. Thank you for the explanation, yes. And there's a question which is not connected to today's material, but to the forthcoming midterm test. Will there be any sample or something like that, or some information about how to prepare to it better?
Okay, I was about to introduce you the midterm exam now. I can then start from the beginning. We have it planned on the 14th of the December, so this would be already next week that we plan it. It will cover the first 6 topics will organize it on the Examus platform. You will do it, there would be proctoring, but asynchronous proctoring would just look at they will have records of your work in there, but there won't be person watching after you. We will just consider it for the if there will be some doubts, we will have a chance to look at the video, make sure that you did it ethically. Or last year, some of the students claimed that they wrote correct answers, but the system perceived another one. Then we look at the video and see that actually he wrote what we see. So in that cases, in that sense, the videos are very useful, and this is why we have to introduce them. There will be 10 questions. Most of them would be numerical exercise, but there will be some of them would be theoretical one. The topics, Saad Ahmed, topics, you can look at them at the first presentation for the first class. It would be first 5 lectures, first 6 lectures, including this one. This would be cash flow, introductions, cash flows, bonds, stocks, and the risks. Those are we will send you more detailed information on the procedure there, but no, this is 40 minutes, 10 questions with asynchronous proctoring. Yes, the sample, we do not offer you the separate sample there, but no, just recalculate the exercises that we do on the seminar, and they are very similar in the structure, in the topics. There won't be anything that we haven't discussed either on the lecture or on the seminar. So just in order to prepare, just work on the materials that we share with you on the lectures. Recalculate them. Repeat the date of the exam. It's 14th of December. The exercise is not here. There will be both, Ksenia, exercises and theory, but mostly numerical exercises. And by the way, yes, you are allowed to use Excel spreadsheets. Also, you will be allowed to use the blank piece of paper. At the beginning of the test, you will have to demonstrate this blank piece of paper in order to make a notes or something. But you are not allowed to use the formulas or any additional notes. Any pre-written notes are forbidden. We have very little number of formulas within the course, and they are very much repetitive. So I feel that it's very easy to learn them by heart. Even not by heart, behind all of them there is a quite straightforward logic that I spent a lot of efforts delivering to you. So keeping this logic makes it easy to remember and easy to recall in your head. This exam, our midterm exam, should be in your schedule. We have it in ours, and it should be in yours. Vladislav told me that some of you reported there are some other teachers announced anything on that day, but there shouldn't be anything. Just tell them that you have an exam in corporate finance. Yes, so we have only one attempt for that. You are not allowed to skip it.
If something wrong will go with exams, should we write to you? Yes, to your corporate email.
Artyom, what?
If something wrong will happen with exams, because in last year there were a lot of cases when exams just say goodbye and everything was bad. If something wrong will go with exams, we should write to your corporate email?
Yes. We will send you separate instructions there. But no, we have some cases of technical problems. I cannot agree that there are massive. There are some small percentage of those problems, but we always try. We all of them. We figured all of them, and everyone were satisfied because we do it not the first time. But no, yeah, we will be understanding in this part. But no, do your part if you can. Like, of course, no one is safe from any misfortune, but make sure that you have working computer, check the system in advance, pay for the internet, like wherever, make some preparations from your part in order to avoid stress. And anything else? So usually students usually do it lower. The results are not that good usually, but maybe you surprise us in a positive way. Just make sure that you do not cheat. There are every year we caught some cheating, and then at least you would have 0 for this part, maybe depending on how bad this cheating was. Maybe we would initiate some formal procedure to punish for that. Make sure you work by yourself here. And again, we are open to help you to prepare if something is unclear. I myself, Vladislav, we are very happy to explain some problematic things that you see. If you need, just send us request. We will spend some time additionally. Also, there is I uploaded the project. I uploaded the information about the homework that you should submit in Smart LMS. Please also read it, and we'll try to describe it rather in detail. But if there are some questions, also please ask them. But we do not accept kind of questions how to do this, how to do that. It is something that you should figure out yourself. Anything else?
You said we can use the Excel. You mean the blank Excel sheet, right?
Yes, blank Excel spreadsheet. We will see everything that goes on your screen, and if we see some misbehaving, then we'll have to put 0 for the test. At least put 0 for the test. Otherwise, but blank Excel, yes, you can use it, and you are encouraged to use it.
Oh, thank you.
No calculators, because it's first of all, we just do not need calculators in these days finance, but also it's difficult to say what you have there looking at the videos. So in order to avoid any misunderstanding, you can replicate all the calculations in Excel that you can do on calculator, so go with that.
Victor Valeryevich, could we use blank spreadsheets and pencils just to write down formulas while we are writing an exam?
Yes, you are allowed to use blank papers and make some notes there. Yes.
Okay, thanks.
Yes, so also these days there are some innovation in proctoring that they offer us option to have second camera from other side of you, but we will skip that. I think it's too much. So just a single camera. You will need to show at the beginning what you have around, what you have on the table. But this nothing too special there. I understand that there is some stress associated with all those things, but we cannot make the life of the student completely free from the stress. What to do? There are some points where we need to estimate your progress, and this is this moment, and this is very good case, a very good chance for you to learn the things better.
And will we be able to switch from one question to another one? For example, we missed the first one, but then we decide to return to that. Can we do that?
Yes, Polina, yes. You can go back and forth there, just not forget to choose some option. No, actually most of the exercises you will need to write number there, so the chances to guess would be negligible, but still make sure that you write what you wanted to write. The system is quite stable itself. It's working fine. We had multiple levels of examination already there, and there weren't mistakes. Just some individual cases, and mostly there were some problems on the student side. But again, we are quite understandable. If there are some problems, make sure that you somehow have the evidence that there are some technical problems. Inform us immediately, and we'll figure out what to do. Good. Good luck with all of those things then. This week you have a series of seminars with Vladislav. Spend some time preparing for the midterm. You can ask questions on the previous topics if you have some. We are there to help you, but anyway, the most part should be done from your side now. Just read the book, read the lecture materials, replicate the calculations, and then you will be well prepared for the things we have prepared for you. Good. Seems like we are over for today. Thank you. Nice to hear you and read some messages for you. See you next week.
Thank you. Goodbye.
Thank you. Goodbye.
Goodbye.
Thank you.
Bye. Bye.